Perfect. So to kick things off today, I just wanted to start by saying welcome to those of you who are here live. Thank you so much for joining me on a Friday morning. Did just say it's a very hot day talking about credit control on a rainy Friday morning, but I am so grateful to have you guys here. And if you're watching on demand, I'm really, really excited that you guys are here as well. So I always start with this slide because we are all British and talking about finances feels weird, and we're not taught to do it, and we're not taught this stuff at school. And so I always try and encourage people, anyone who joins any of the sessions or webinars that we do, to take a picture and share the fact that you are here, talk about it on social media, talk about it with your small business owner friends, because actually this is the way that we change the game for access to financial education to self-employed people, because we're not taught about this stuff at school. Sometimes it can feel very difficult to talk about, especially topics like this, which involve not getting paid, struggling to get paid. There's a lot of sort of like mental headspace and self-worth attached to not getting paid for what you do as a self-employed person. And so I always encourage people to share the fact that you're here, because it actually might encourage somebody else to tackle their finances in a similar way. So I thought I would just very, very quickly kick off by running you through who I am. So I normally just start with what would come up if you Googled who is Rachel Harris. So I own one of the UK's fastest scaling accountancy practices. So we've scaled from a one-man band 3 years ago up to we're now a team of 17. We have just hit £1 million business valuation, and we've got 750 awesome clients, some of whom are here today. I am the founder of Accountant She, which is the online platform that I needed at various points in my journey when I was looking for careers advice, understanding if I'd like to become an accountant, through to starting my own business, starting my own practice, and scaling the business as well. So I create completely free, accessible, long and short form content for people who need it and actually shouldn't have to pay for it in 2023. As well as being an accountant, I went on to do an MBA, which is a master's in business, and became a chartered manager. I am nearly a full-time content creator as part of running the business. I'm a director and trustee of AAT, and I founded the first ever corporate bursary scheme, which fully funds somebody through their accounting training every year, because again, I believe that access to funding and financial education shouldn't limit our job opportunities. So, all right, today we're going to run through the top mistakes that we see in practice. I feel like one of the best bits about being an accountant is getting to see inside other people's businesses. And so I actually thought it would be super juicy if I just run you guys through the top mistakes that we see. You can see if you do any of them, if you're like, oh yeah, no, I definitely wouldn't do that. So kicking off with the top mistakes that we see, then just running through what credit control actually is. It is quite like a financy word. Credit control and that process is just all about getting paid faster, getting paid on time, and making sure that you're getting paid in a way that enhances the relationship that you have with your clients. I then split the credit control process into before, during, and after. I think lots of people think that credit control just happens after you've invoiced somebody, but actually we can do it long before we ever even send an invoice. So let's just do a deep dive into the top mistakes that we see as accountants in small business owner land. So the first is assuming that all clients are the same. So it doesn't matter if you have 99 customers who all process your invoices in the same way. The 100th could be different, or it could be your first and second clients are completely different. And if you don't send the invoice just exactly the way that they like it, they might not get paid. This is something that I see as a content creator. I've worked with huge companies all the way through to independent companies, and everybody works differently. Some want a purchase order, some just want an email. It is so difficult to manage that. And so if actually you don't send that invoice in exactly the way that they like it, you actually might not get paid. And so whenever you land a new customer, my top tips on that one would be to always ask your potential customer, who do I talk to about invoices getting paid? What information needs to get onto the invoice in order for me to get paid? And when do you do payment runs? So the first mistake that we see is assuming that all of their clients are the same and they just send templated emails out every single time. And so if you've got this information to hand, the information that you've asked for, you actually won't waste time sending an invoice that just they actually can't pay or they won't pay, or chasing the wrong person if it hasn't been paid. Next up is having unclear payment terms. So it's really important to spell out how long your customer has to actually pay you and identify and be very clear about any late fees that they might incur. So we put these into a sort of condition of sale document or somewhere on your website. So for accountants, we have a letter of engagement in order to sign that physically or digitally before you actually start doing any business with that person. And that way the customer can't be under any confusion or any misunderstanding as a defense for any late payment. And so we've got loads and loads of guides on payment terms. The third is slow invoicing. I feel like in small business owner land, slow invoicing isn't a problem, but as you start to scale, sometimes it can. And so sending invoices as soon as you can. So like immediately after delivering the product or service is the very best time. And because that's when your customers will be feeling the most goodwill, they'll be really happy, it will be really fresh in their mind, and they'll be more receptive to actually paying you. The second best time to send an invoice is right now. So customers actually can't pay what they haven't been invoiced. And so making sure you are invoicing, but then making sure that you are invoicing very, very promptly as well. My fourth is giving up. Late payment is very common and it can be very tempting to give in and just accept that it's part of life. It's definitely a part of business that we see so many small business owners just really unprepared for, especially if like we're a very core values business. I lead with my heart. It feels very personal, the relationships that we have with people. And so whilst feeling that all of your relationships are personal and not having the tools and knowledge to react to people not paying you, it can actually be quite easy to feel like you should give up. And so I just wanted to encourage you to not give up. It's really, really important, and I'm going to take you through a process later on, but we're going to be talking about reviewing outstanding invoices really, really regularly, highlighting the ones that are the furthest overdue, the ones that are worth the most as well, and prioritizing them in that order, and then make a plan to get them sorted out. So speaking with the customer and considering things like offering different payment methods, actually understanding why they're not paying you, because sometimes there is a reason, giving things like early payment incentives or changing the credit terms to align with your customer better. There are loads and loads of options. So throughout today, we're going to talk about all of the different options that we've got, how to actually do credit control, how to understand who owes you money. And don't worry if it doesn't work the first couple of times. Every customer, every invoice is unique and different. And the only way you'll actually fail is by giving up. And so I just wanted to like really deep dive into that because there's so much well-being attached to people not paying. And then finally, actually, we do see a lot of people shying away from the phone. It is 2023. We're all running digital businesses, and very often it can feel hard to pick up the phone to somebody, especially if they're not paying you, and it might feel like it's going to be a little bit confrontational. But when the due date is up, tell your customer that they are late. Some research that was done recently actually found that 80% of unpaid invoices can be collected through email chasing alone. So again, start there. But when that is not enough, it's really important to pick up the phone. Like customers just find it harder to justify late payment when you've got them on the phone, especially if you have a personal relationship with them. It can be much harder for them to sort of just hide behind emails and not engage with you. And so if there are issues to sort out, you can actually just talk about them, human being to human being, go through any reasons why they might not be paying you, and put together a plan of action. So within our business, we do things like payment plans and just having conversations around them really breaks down those barriers and actually reduces the amount of confrontation that's in there to start with. So what is credit control? As an accountant, credit control has been part of my life for a long time, 10 years, but credit control is literally your job as a business owner to control the amount of credit that you are giving people within your business. And if you're a small business like ours, and specifically for me within Accountant Machine, where I do lots of content creation and speaking gigs, I end up waiting a long time to get paid. And it can sometimes feel like, actually, I haven't consented to giving anyone credit. Like, is it credit control if I'm not intentionally giving a line of credit? And what I mean by credit is just the time difference between you delivering your work and that person paying you. They are in credit. And so credit control is our way of controlling how much credit we are giving away within the business. And so again, I mentioned earlier, there's lots of different ways to charge for your services, lots of different ways to invoices as well. And so healthy cash flow is really important for any business. Like as accountants, we see this time and time again. It is literally make or break within the first couple of years and getting into that really great financial well-being routine. So business owners who are setting clear payment terms with their customers, invoicing quickly and following up on late payments can actually avoid and mitigate a lot of those cash flow crunches that can get quite tight for small businesses. So in this section, when we're talking about credit control, I actually want to run you through how to decide which invoicing method is best for your business. So if I just map out what credit control is to start with, so credit control is the process by which your small business can ensure that you only give credit to customers or clients who are actually able to pay you back. And then when they do pay you, they actually do it on time. And so that term credit can apply to a financial sum or product or service that you provide upfront before you've been paid. And so today we're going to go through that credit control process, and I'm going to give you the tools to understand, firstly, if your customer is somebody who you should be giving credit to, or actually should you be asking for payment in advance if they can't justify or prove that they should be given credit to. So next up, we're going to talk about which invoice method is actually best for your business. So the best type of invoice method for you guys will depend on your industry, your business size, and your clients' needs. So do you perform ongoing services or send one-off orders? Sole traders and freelance will often use like automated or recurring invoices using accounting software. And so these let you take payment at regular intervals for ongoing projects with your clients. And so there's lots of different ways to invoice. Lots of industries have very industry specific, like set ways of doing things. And there's so many different options available at the moment from, if you're in an industry where there are credit control problems, you might want to get paid in advance of doing any work. If you're a builder and you have to spend money in order to deliver the job buying materials, you'll want to get paid in advance, all the way through to people who have long lines of credit, because actually that means that businesses spend more with them. And when they get paid, they're getting paid more, but they need that longer line of credit. And so lots of people confuse credit control and debt collection. And so the credit control process can really be split into like two main areas. And so the first is how you decide or control who you give credit to, which is credit control. And then the second is actually debt collection and how you chase those debts. And so both aspects of credit control are really important, and we're going to go through them today. And so being able to identify customers who are more likely to be able to pay you back reduces the risk of non-payment. And then robust debt collection processes can really help you to ensure that when you do have problems getting people to pay, you've actually got a much higher chance of success. Non-payment will cause lots of cash flow problems within your business, which can escalate very quickly. And so putting these processes in place will really help you to minimize that risk within your business. So we've gone through the process, how that process can impact your business, the importance of actually having this process and understanding the difference between credit control and debt collection. So this is where things get interesting. And this is where, as an accountant with an MBA, this is where it gets really fun and nerdy. And I'm really hoping that you guys will understand and just take so much away from, oh my gosh, I've literally just been taking work and been really excited to get work. I've actually not been thinking about understanding my customer payment terms or that process. And so I'm just really excited to hear your feedback actually at the end and see how much you've taken from today. So the first thing to understand when we're raising sales invoices, when we're working with customers, all the way through to chasing those debts, is that the credit control process actually begins before your sale is made. And so this is the point where you should be finding out as much relevant information as possible about your customer. So the more you know, the more informed your decision to give credit or not will be. The more detail at this point can also make any later debt collection a lot easier, should it come to that. And the two key ways that you can use to learn about your customer is through an application form and then maybe even a credit check, depending on the value of the work that you're doing. So a credit check will allow you to view your customer's credit report to see their previous behavior when it comes to paying their lenders. And so again, it's very, very similar to a personal credit check. So you will have heard of agencies like Experian, which can provide business and consumer credit checks. And then it's also really important to build up your own information on existing customers that can be used in the future. And so if you've got customers with a history of non-payment in your business, then it's really important to actually ensure that there's a process in place to record this from preventing it happening. And so generally, bigger businesses or businesses with much higher values would then sit into the part of business where they would actually do credit checks. But there are lots and lots of pre-sale checks that you can do as a small business owner that will make this a lot easier. And so I actually just thought I would run through what we do at Strivex within our accountancy practice. Obviously 750 clients, we do quite a lot of pre-sale checks. As accountants, there are regulatory things that we have to do, but then there's also things that we do within Strivex that really help us to increase the amount of information that we have on our clients to make sure that we understand whether or not we're going to get paid and to identify any red flags. So first up is a direct debit mandate. And so I'm just going to run you through the parts of our onboarding that are specific to future credit control. If you're a client watching this, I think this will be quite interesting because you'll be like, oh my gosh, that's why they did that. So as we onboard a client, we get everybody to sign a direct debit mandate with, an explicit, what's the word I'm looking for? Disclaimer, with a disclaimer that we obviously won't ever collect any money without letting you know. We have to invoice, and then 14 days later, that's when the direct debit will be collected. But we get all brand new customers to sign a direct debit mandate. That is basically their intention to pay. If I'm onboarding a new client and they've got an accountancy fee of £2,000 or £3,000, it requires a lot of work upfront for us to onboard that client, request information from their previous accountant, to get them set up on all of their new softwares, to do a one-to-one training session. Like, we have to deliver a lot of work upfront, and that's all part of the service. I don't want the customer to pay for that, but I do want their intention to pay for the actual deliverable bits of work. And so when we onboard a client, they all sign a direct debit mandate to give us that intention to pay. If someone won't sign a direct debit mandate, actually, I take that they're not intending to actually pay me for my services. And so we don't onboard them if they're not willing to sign a direct debit mandate. Again, we also get email notifications if people randomly cancel direct debit mandates. That's a big red flag. And so if somebody cancels a direct debit mandate, we'll just get in touch with them to say, like, hey, like, if you're changing banks, here's the link to get it reset up. If you are not, is it okay if we just book in a call to have a chat about things? Again, that's a really great opportunity for us to add value. Maybe send them a recording of this webinar and say, if you're having credit control issues, if you need to get some cash in, you can do X, Y, Z, but actually cancelling this direct debit mandate means that we can't work together. We do lots of anti-money laundering checks, which are regulatory, but again, just really improve the transparency of the people that we're working with. Respect for the system. So this is really interesting, and I'm not sure how many other accountants do this, but one of our key points when we are speaking to prospective clients, when we're deciding if we want to work with them, is actually how respectful they are of the tax system. I am a qualified accountant. I own and run a chartered accountancy practice. I'm all about helping small business owners pay as little tax as possible, but as little tax as possible that's correct. And so we are not here to be getting tax bills down in any other way other than the statutory and compliant way. And so actually making sure that that person has a respect for the tax system that we are actually a really big part of as accountants. So if they've got loads of bills outstanding with HMRC, if they owe HMRC a lot of money, actually that's an indicator to me that they don't respect the tax system. And by default, or as an extension of that, they're probably not going to respect me and my team, whether that's financially or in the way that they behave. And so we actually have an explicit conversation with new clients about respect for the system, and we just try and catch any red flags. And again, that comes on to taxes outstanding. We then also have in our internal CRM, we have a red flag process. So any member of the team can red flag a client at any time. We are a very strong core values firm. Lots of people choose to work with us because of the core values that we hold. When clients sign their proposal, when they sign their engagement letter, they agree to uphold those values as well. And so any member of the team can actually red flag a client. So things that might indicate that they aren't respectful of our services or our time, which would then lead on to them not paying us, are things like booking meetings and cancelling them, which life happens absolutely fine. But if somebody is like repeatedly doing it, we would then red flag them. If they're rude, like again, that lack of respect might feed into the credit control process. And so we have a red flag system within our CRM, so any member of staff can red flag a client. But I just thought some of the best bits about this content and the webinars that we run is actually just being able to show you guys what we do inside our business, in case that gives you any sort of like inspiration, or I wonder if I could take that little bit and do it in mine as well. So those are the know your customer pre-sale checks. Credit control starts before you've even made a sale. And now we're going to move on to payment terms. So again, healthy cash flow is at the center of this conversation today. And for healthy cash flow, it's so important to make sure you're setting clear payment terms, not only so your customers know when they need to pay you, but so that you can try and anticipate and forecast when you are going to be paid. So business owners who set up clear payment terms, are invoicing quickly and following up on late payments, will be able to avoid that cash flow crunch. So once you've done that, once you have done your pre-customer checks and you've actually been trying to understand how much credit you're going to give that customer without receiving payment, then we need to make sure that we've got terms and agreements between you two to get that formalized upfront before you then start delivering the work. So the purpose of your payment terms is to explicitly outline exactly how and when your customers are going to be paying you. So some business owners draw up a document to share with potential customers outlining their fees and their terms. Others just include them in their work contracts and invoices. So whenever we speak to a prospective client, we prepare a proposal which breaks down every single service that we've spoken about. It could be these are the services that you're going to start with, but as your business grows, you might want to take on these. And we map out payment terms, we map out how and when we invoice, and the need for a direct debit mandate completely up front, so that before that person starts to work with us, they've got clarity on what that is, what it looks like, what they're paying for, how they're paying for it, and when they need to pay for it as well. So however you decide to communicate your payment terms with customers, we need to make sure that they include a couple of different things. So the first thing that you need to be communicating with your potential customers are when payment is due. Next up is actually how they can pay you, so accepted forms of payment, whether that's cash, credit card, debit card, PayPal, e-transfer, credit, like all of the different payment options. So first up is when payment is due. Second up is how they can pay you. Third is your preferred currency. So lots of our clients work internationally. They work with clients all over the world. Maybe they sell digital products. We're just continuously looking at what their preferred currency should be. And then also any early payment discounts or late payment penalties. So within your terms, there's 4 things that you need to map out for your customers, which is when payment is due, how they can pay you, what currency you want paid in, and if there's any incentives or deterrents to paying early or paying late. So then the endless debate within credit control is, what should my payments be? Do I want payment up front? Is it 10 days, 30 days? That's what net 10 and net 30 mean. Is it 30 days at the end of the month that you've invoiced? And so in the business world, it's very customary to be paid within 30 days of invoicing. However, as a small business owner, you can set the payment terms that suit you best. So if you need paying in advance, if you need paying up front, you can set those terms. It'll just be about finding customers who will adhere to them. So if you're a freelancer, for example, you might require partial payment up front with the balance due upon completion of your services. We see lots of people do that. We see lots of people take a deposit at the beginning and then invoice on completion at the end. And so depending on the industry standard, or whether your clients pay you electronically or by check, God forbid, you might stipulate a shorter or longer payment deadline. And so in the digital age, it's actually not uncommon at all for small business owners to settle a net 10 or net 14 deadline, or to actually negotiate payment terms on a client by client basis. And so when it comes to payment terms, if you're having this, if you're going through this at the moment, I would just encourage you to take into account literally what works best for you and your customers. And it's literally just about being very clear about expectations, and managing those expectations will increase the likelihood that you are paid on time. And so regardless of your industry, regardless of where you work, I would encourage you to concentrate on what makes sense for your business. Like if you are having to spend money, you should be taking at least part of that money up front. If you are maybe service-based, sometimes it's quite hard to ask for money up front. You could maybe do it in installments. And so say, you know, for every 8 hours of work, I'm going to drip feed invoices rather than waiting until the end. And so really, as a small business owner, the focus should be what works for you and what makes sense for your industry. So before you take on a client, we're looking at understanding your customer and understanding your payment terms. And then next up, you've actually taken on the client and done some work. Now we're going to talk about invoicing. So it's in your best interest to invoice immediately because after all, the sooner you request payment, the sooner you will receive it. Some small business owners actually offer early payment discounts as an incentive to pay faster. So typically for net 30 invoices, we'll very often see things like a discount of between 1.5 and 2%. And many customers will appreciate the opportunity to save some money. Many business owners don't miss the small amount that's been taken off the bill because actually getting that payment is faster, and the amount of time it saves having to chase that invoice, you make back that 1.5 to 2% off the invoice as well. So customers who routinely pay late would actually be motivated not to pay early, but if you incentivize them to not pay late, so they will actually be more motivated by a late payment penalty. Again, also in the 1 to 2% range of an early payment discount, you would then start adding that onto the invoice at the end if they're late. I'd then also suggest making it a policy to email a friendly reminder on the date that payment is due. If payment is late, follow up with a phone call the next day to just find out when you can expect payment. So now you've invoiced your customer. We're looking at when to invoice, when to follow up, how you can automate things as much as possible. So I'm actually just going to come on to keeping it as easy as possible. So I think sometimes people, when they become self-employed, their business changes a lot from being self-employed to where they are now. And it could be that your invoicing process hasn't changed, whether that is you're using a template that you found on Canva to invoice all of your customers, all the way through to using accounting software. We just want to keep it as easy as possible. So those pre-customer checks don't have to be a very, very big formal process for us. That's just part of the checklist that we run through whenever we speak to any potential client. It's great boundary setting. It's a great way to filter out clients who actually were going to become difficult clients that save us all time and money. And then when we move into actually invoicing, how can we utilize automation as much as possible? So the more automated you can make your payment system and your invoice system, the easier it's going to be for your customers, rather than expecting them to send you a check or pay you in cash. Perhaps it gives them the functionality to pay you online. So with us, we work on softwares like Xero, QuickBooks, and Sage. And so we see people invoicing automatically. Whenever we take on a customer, we automatically draft an invoice so that once we've done the work, it is good to go. We integrate electronic direct debit mandates into our processes, which automatically talk to our accounting software. So we can see before we've even raised an invoice, does this person have a direct debit mandate? If you don't use direct debits, but you do want people to pay you online, Xero, QuickBooks, and Sage all have the functionality to build in online payments to the invoice so that when your customer receives an invoice by email, they can literally just click a button and pay now. Again, with direct debits are becoming quicker and easier than ever. 5 years ago, before I became self-employed, I worked in a company to set up a direct debit mandate process, and it was awful. All of the mandates were paper-based. They had to be signed on paper, and we had to post them to the bank to get direct debit set up, but they really, really are easier than ever. Direct debits, very often, if you do repetitive, ongoing work on a repeating invoice, I would recommend you having a look at direct debits if you've not considered it before. It takes so much of the effort out of, and even the headspace of understanding how you're going to get paid and when you're going to get paid. And so if you are considering your payment process, if you're considering what that workflow looks like for your customer, it's all about reducing the barriers to getting them to pay you. So maybe even as it stands at the moment, send yourself an invoice as if you are your client and try and go through that process yourself. So if it is an invoice that's made on Word or Canva, actually in order for me to pay that invoice, I'm going to have to log into my online banking, set you up as a payee, check those bank details. I might even need to call you to check those bank details because of fraud. So I'm going to have to set you up on my bank, call you to check the bank details, then confirm it, then make a manual payment. I then need to check the reference number that I'm using and type that into the online banking, then send it to you. And then, because it's 2023 and we're all terrified, I then need to email you and say, please, can you confirm that you've received the payment? That's quite difficult. And actually, I do a lot of like productivity, and I'm all about trying to work out how I can get through my to-do list as fast as possible. By default, human brains assume that they can deal with any email in 2 minutes or less, unless they are told that it's going to take you 10 minutes. And so actually, if somebody comes to pay your invoice thinking that it's going to take you 2 minutes, that process is very manual. It's going to take them more than 2 minutes. And so actually, they're probably just going to move on to the next task and come back to that later, which then means that it will be forgotten. And that's when you then need to start putting time, effort, and money into chasing that payment. And so I'd encourage you to walk yourself through your own credit control process, reduce all of the barriers, because that process would have been a lot easier if you just had to press one button on your phone to send the invoice out. You'd already checked with that person in advance who the best person is to send that invoice to, when do you do payment runs, how can I get paid, what reference numbers do I need to add on to that. You've checked all of that information, so you know that invoice is going to the right place. You're sending it all electronically. You've got all of your ducks in a row, and you know exactly where you stand. So go through your own credit control process, go through receiving an invoice within your own business, and understand if you could make that any easier. So with credit control, not many business owners, or not many at all, actually have a formal, credit control process when they first start in business. They very simply just issue invoices and hope for the best. But a large proportion of invoices aren't paid on time. And so before long, that begins to take its toll. Cash flow will then become an issue, and then chasing payments is a big pain in the bum, to be honest. And so if you're sending like 25 or more invoices a month, it is probably time to set up a credit control process. Or actually, if you are spending more than an hour a month chasing your invoices, you probably need a credit control process. So these are my top tips for setting up a formal credit control process within your business. And this is the after part. So before, we want to do know your customer checks, we want to be clear on payment terms, and then we want to invoice to the right person with the right terms, the right amount at the right time. This is the credit control process that should be happening if you're getting to a position where you're not being paid. So first up is financial reporting. Do you have explicit clarity on who owes you money? If you don't, there's probably a financial well-being conversation that we need to have around how you're managing your accounting software, how often you are reconciling your bank. If your accountant does your bookkeeping for you, it could be actually that you want them to reconcile it more frequently so that you've got weekly insight into who owes you money and when. So within the financial reporting, do you have and do you know how to find explicit clarity on who owes you money? So with things like Xero, QuickBooks, and Sage, that's going to be, is my bank up to date? So have I told my accounting software who has already paid me? Yes. Okay, I'm going to go in, I'm going to run an aged debtors report, which shows who owes me money, and then I'm going to go down the list. We need, as small business owners, to be chasing quickly and chasing often. That we need to be getting in touch with people the day it is due to ask when payment is going to be made. If there's no direct debits in place, obviously if there's direct debits, we don't need to do anything, that's completely hands-free, but we need to be chasing quickly and we need to be chasing often. So we need to, and again, all of this can be automated in accounting software. So you can automate, once my bank rec is up to date, on the day somebody owes me money and my accounting software thinks that that's outstanding, I'm going to email that person and say, hey, your invoice is due today. Can you just let me know if payment is going to be made by the end of today? If not, can you just pick up the phone and give me a call? So we're chasing quick, we're chasing often, we're getting in touch with people on the day that that invoice is due. And then past that day, we're getting in touch with them very, very frequently. So we want to be sending them statements as soon as they're overdue. So for anyone that doesn't know, a statement of account, you might have received one. If you're a client of ours, you might have received a statement from us before. So a statement as opposed to an invoice. A statement is literally a statement of all of the invoices that are outstanding, and an invoice is just one request for payment. So actually sending a statement is a really lovely way to give a customer a summary of like the actual total amount of money that you are chasing, because it could be that one invoice is a month overdue, one invoice is 2 weeks overdue. Actually, a statement would say you owe us all of this money, not just all of these separate invoices. I then really encourage you, and again, you can use the templates that are set up in accounting software. So accounting software really work very hard with people like us, with accountants, to give you guys draft emails for a first, second, and final chase. I would really encourage you to write this in your own tone of voice. We're not a super corporate firm, and so actually like using a template that is signed off by like dear sir or madam, if one of our clients received that, they'd be like, what have you done with Rachel and James? And so making sure that it's in your tone of voice. Again, people do business with people, people pay people, but people ignore corporate organizations and they don't pay them. So there is a huge motivation to put your tone of voice into the credit control process. And then also personalize it to your customers. So you can use drafts. You can draft a first, second, and final chase. But you can use that draft and personalize it to your customers. So if it was Gemma, I would say, hi Gemma, I saw that you bought a ticket to our Christmas party last week, like really looking forward to seeing you. Just wanted to pop you a statement because as of today, a couple of your invoices have gone overdue. Can you just let me know? And so you can template a lot of it, but it could be that you want to personalize it to your customer so that your customer actually understands that you are manually reviewing each debt that's going out and really trying to like proactively receive payment. And then my final, almost parting word of credit control and the credit control process, that before, during, and after piece. My final point on after is what happens after you get paid. If you've got a customer that is a massive pain in the bum and you've had to chase them 5 times, first, second, and final chase, and then 2 phone calls in order to get paid, I need to challenge you on what you're going to do when you actually get paid. So for us, we've already red flagged that person before they've even paid us. We wait for them to pay us, and then we actually say to them, I'm really sorry, we can't go through this again. And so for next year, you're going to have to find another accountant because we cannot work like this. This is not fair on anybody. It's not fair on me because I have to pay my team wages regardless of if you've paid me. And so I just want to encourage you at the end of your credit control process, what is going to happen after you've been paid? What are you going to do then? So for us, we red flag them, we get in touch with them, we explain to them that was actually quite stressful for us. That wasn't nice for us. It probably wasn't nice for them. We're a small business. We're a small business. And so I'm still paying people's wages. I still have to do all of those things. That doesn't go away just because they haven't paid us. And so we just try and give them some very honest feedback and tell them that unfortunately we just can't continue working together. So my parting word, and I intentionally put this at the end, was I want to challenge you on what you're going to do when you get paid, because I think a lot of people just relax. They're so relieved that they've been paid and then they continue. But I want to encourage you to have a little wrap up process or a close down process on exactly what happens when you have been paid. That was a lot. That was a lot. And this is probably one of the more, not technical, but maybe slightly more intense sessions that I've done. But I'm really excited. It feels like the more focused this content is, the more we can use it to develop and encourage clients with their processes as well. I would love to take some questions if anybody has any questions, and I will stop our recording here.